time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Okay, for your stock, our take is on VitalHub Corp, symbol VHI. I'll be handling it on the TSX. Trades around $2.45. Market cap is $106 million. Doesn't pay a dividend. What does VitalHub do? They are a software consolidator focused on the healthcare vertical. Its primary products include electronic medical records, EMR, and patient flow solutions. VitalHub is based in Toronto and has over 400 clients. Now, Q3 results, we saw good revenue growth, up 48% to 97 or 9.78 million from 3.1 from the comparative period. Organic annual recurring revenue bookings grew at 2.7% sequentially, despite this being a summer season that is slower, essentially. Now, however, the weaker British pound hit annual recurring revenue by 1.1 million. The quarter was recorded during the peak of the UK budget crisis. Now, adjusted EBITDA was 2.15 million, 22% of revenues compared to 1.24 million or 19% of revenues in the comparable period. Net income was basically break even at 40,000, up from a loss at this time last year of 575,000. Now, the balance sheet, VitalHub has a strong balance sheet, but it's not from internally generated cash flow. I mean, there is cash flow here, but the company has continued to issue shares to fund growth. Cash on hand right now is 36 million compared to 16.3 million. The company did a raise over the past year against loans payable around 9 million. So the net cash is in the range of 25 million to execute acquisition initiatives on. In that vein, subsequent to the end of the quarter, the company acquired all the issued shares of a company called Quad Community Technologies, which operates in Australia. Quad offers an online case management system and supporting products serving 350 plus agencies located in all states and internal territories of Australia. VitalHub paid roughly 7.1 million Canadian. What are the valuations on VitalHub? Well, it trades at a trailing or a price to earnings ratio based on 2022 expected earnings, just trailing earnings of 48, which is expected to drop based on 2023 earnings. This is expected to around the range of 18.5. Keep in mind that EPS missed expectations in the last quarter, but the EPS has improved in 2022. Price to free cash flow based on expected numbers for this year is 9.4. That's a more favorable look. There has been good growth in the business, revenue growth primarily from acquisition, a reasonable amount of organic growth sprinkled in since 2017. Revenues in 2017 were 1.1 million. Revenues for the trailing 12 months are 35.5 million. Operating income over that period also improved from a loss of 2.1 to trailing 12 months profit of 3.5 million on operating. That's operating earnings. Now, however, for a company with an enterprise value of 79 million, this still leaves the company trading at 22.5 times that operating earnings figure. Reported EV to EBITDA is in the range of 14.8, but on an adjusted basis, it's closer to 8.4. Now, according to analyst estimates, VitalHub trades at 6.3 times its expected EBITDA in 2023, compared to more mature consolidators, software consolidators, which are in the range of 14.2. The goal of management, we've met with them a number of times, is to drive margins higher with further organic growth and cost reductions, demonstrating an ability to compound free cash flow per share. Now, if the company can do so and actually post higher free cash flow per share, its multiple could re-rate higher to that same group that we talk about that has a higher multiple. We are awaiting execution on higher per share cash flow growth before we buy VitalHub. So we're watching the company. It is interesting. It has come off again this year, and we're seeing if it trades in a range, but more focused in on it growing on a per share basis in terms of cash flow and earnings.
Right. It is an interesting company. I remember we met with the management team, Brennan, you and I, when we went to the Roth conference. What was that, in March, April?
March.
Yeah.
March, right. Yeah. So we sat down with the management team. It was interesting business. One of the things that I liked is they'll make acquisitions of technology companies roll those into their business, but then they'll use their own tech team to further develop. So they're, a lot of times these smaller companies, tech companies, they might be a little bit inefficient with their software development costs, but VitalHub has their own tech team that they would then just use to continue to maintain and grow that software. So certainly interesting. The valuation, I mean, if you're going to look at the adjusted figures, it's not that bad. Would you say 9 times free cash flow, net cash position of about a third of it?
And that's based on estimate. So, I mean, they have to hit it, but they have
to hit it. And if we're talking adjusted, what are they adjusting out? So you need to look at that too.
It's true. And I mean, we just, on a per share basis, it just needs to create, I mean, because there is dilution with raises over time. I do think that management would be more hesitant in the current range to issue more shares. But, it is, and there is cash there too.
Well, it makes it hard. I mean, if your cost of issuing shares is so high, that means your cost of making an acquisition is high. Mind you, the price of those acquisitions have probably come down in the current market.
But for software consolidators, or any consolidators, you actually want to trade at a higher multiple, right? You actually want to at some point. So if you do have to issue shares, the math on purchasing a private or another public company works. But if you're, trading at 8 times EV to EBITDA and buying things at 7.5 times, it's a thin margin that it's a razor thin margin that you have in terms of actually being accretive, right? So if you're trading at 15 times and buying things at 6, it starts to make sense. So, that this company at some point will have to have a higher multiple to be able to continue to raise capital that way, or it'll have to be buying, or like you said, the prices will have to come down to 3 times EBITDA or 3 times cash flow or something like that to make the accretion be worthwhile versus the dilution, right? And to make it accretive. Hopefully that makes sense.